A lot of people are worried about a potential housing market crash in 2020, and in this video, I'm going to share what I believe is going to happen to real estate values in Cleveland. What's up, YouTube? Welcome back to the Cleveland Investor Primer channel. My name is Rob, and on this channel, I provide content on the topic of real estate investing in the Cleveland market. If you're new to the channel, please consider subscribing down below and tapping the bell icon so you can get notified every time I publish a new video. And while you're down there, please don't forget to tap the like button as well. It is super helpful for the YouTube algorithm, and every like is greatly appreciated. With everything that's happened in 2020 so far, many Cleveland real estate investors and potential investors are kind of jittery and are nervous and wondering about what's going to happen to property values in the Cleveland market. And I decided to make this particular video to lay out what I believe is going to happen and why. I'm hearing a lot of rumbling on BiggerPockets, YouTube, and other forums from people who believe that the housing market is going to face a pretty significant decline in value over the coming year or so. Just a few weeks ago, Marco from Whiteboard Finance went through a quantitative analysis of housing values and landed at the conclusion that he thinks we can expect to see a decrease in housing prices of up to 34% in a year's time. But what's often overlooked and is absolutely essential to consider is that a macro level analysis of housing prices is very seldom going to give you the full picture of what to expect at any given local level. The local level is key because the outlook for housing prices in Cleveland has very different drivers than housing prices in Las Vegas or Houston or San Francisco. And like most things in this world, the key to making informed projections entails a balance of both quantitative and qualitative analyses. For a number of reasons that I'm going to cover in this video, I actually don't believe that Cleveland real estate values are going to be falling in the foreseeable future. And in fact, I actually think that they are set up for a continued increase for the coming years. For starters, despite major gains over the past few years, housing values in Cleveland are just barely back to the level that they were at in 2006. And in some cases, house prices are still not yet back to the level that they were at in 2006. And compared to other major metros across the country, Cleveland housing values weren't particularly inflated even back in 2006, when a median earning household was able to afford the median priced house in nearly every part of the Cleveland area. You don't have to look very far to find examples of houses that have sold in 2020 for less than they sold for back in 2006 at the previous peak, before the Great Recession absolutely pummeled housing prices in most of the Cleveland area. Take this house, for example, at 7011 Gilbert Avenue in Parma, a suburb on the west side of Cleveland. This property recently sold for $109,000, which is actually $14,000 less than it went for back in 2006. And then similarly over on the east side in Garfield Heights, this house at 13608 Royal Boulevard just sold for $85,000, which is $8,000 less than the $93,000 price it fetched back in 2005. It's also worth noting that the median household income in Census Tract 177201 in Parma, where the Gilbert Avenue house is located, is about $55,000 per year, and that in Census Tract 154603 in Garfield Heights, where the Royal Boulevard house is located, the median household income is about $44,000, meaning that these homes are actually super affordable for the types of residents in these B-grade areas in general. Another factor to consider when thinking about what's potentially going to happen to Cleveland real estate is that the lower end of the wage spectrum is likely to climb significantly in the near future. Target recently announced that their minimum starting wage for any employee would be $15 per hour, which basically means that any person who works full-time at any Target store or distribution center makes at least $30,000 a year. Amazon has actually already had a $15 per hour minimum wage in place for any employee or temp for a while now. And now with Target moving to that $15 minimum as well, it seems more and more likely that other big companies are going to follow suit very soon, more as a preemptive move than anything else to make sure that they're able to retain their employees. Because after all, if you were working as a cashier at, say, Lowe's or Walgreens for well under 15 bucks an hour, wouldn't you want to jump ship if you knew that you could make 15 bucks an hour at Target down the street? And with an annual income of $30,000, even with just a small amount of savings in place, so-so credit, and existing debt of about 300 bucks a month, an individual can reasonably afford to buy and live in a house priced at about $99,000. If it's a couple and both are earning that $15 an hour starting wage, working 40 hours a week, that means they've got a household income of about $60,000. So with those same assumptions in place, this couple can afford to buy a house with a mortgage at about the $200,000 price point. While I don't think this move to a higher minimum wage will have much direct impact on more expensive properties, I do think that properties priced under $200,000 and especially houses priced under $100,000 will see considerable demand increases in the next couple of years based on this affordability factor for folks working in relatively modest entry-level type jobs. And this is almost certainly fuel for the case for property value increases in a market like Cleveland, where the median house in the city proper sells for under $100,000 according to Redfin's data for the past month. Yet another factor to consider is the strength of the economy of the Cleveland area overall. As people are typically not shy to point out, the population of the city of Cleveland has been declining since about the middle of the 20th century when it peaked around 1 million residents. But the thing is, this doesn't really tell the full story. If you look at the overall metro area of Cleveland, which includes not just the city itself, but also its suburbs throughout Cuyahoga County and the neighboring counties, the population of the area has actually been relatively stable for some time. And what's really interesting to look at, and probably more telling than population figures alone, is the per capita GDP of any particular metro area based on the U.S. Bureau of Economic Analysis data. The per capita GDP of the Cleveland area is $58,010, which, when stacked up against the per capita GDP of some of the fastest growing metros in the USA, is actually remarkably strong, landing just between Charlotte at $56,000 and change, and Austin at just shy of $62,000. According to Richard Florida, a University of Toronto professor and an expert in economics, public policy, and urban planning, a rising population can create a false illusion of prosperity, as it did in so many Sunbelt metros, which built their house of cards economies around housing construction and real estate development. But America's economic winners are the places that have improved their productivity. Cuyahoga County, where Cleveland is located, has a GDP of about $88 billion, which is actually larger than any other county in the state of Ohio, and quite remarkably, the economy of Cuyahoga County alone is even larger than the whole state economies of each of 13 other states throughout the country. Almost without a doubt, Cleveland's booming healthcare sector is largely to credit for this impressive per capita GDP, and from where I'm sitting, this seems to bode well for future housing prices in the area. And finally, I guess the elephant in the room is the matter of the pandemic currently at hand and what its impact will be on real estate values throughout the Cleveland area. My hypothesis is that there are some metros that are going to come out of the pandemic as losers, and that there are some metros that are going to come out as winners. And the who's who on this is going to come down to 3 distinct levers: density, tourism, and housing affordability. On the density lever, I suspect that for quite some time, there will be a lot less demand for housing in tight, dense places where people have to share elevators and laundry rooms and lack personal outdoor space. I'm not so sure that it means that everyone will want to live in a big suburban house on a quarter-acre cul-de-sac lot, but I am pretty sure there will be a lot less interest in living in the types of close quarters like you'll typically find in much of San Francisco or Manhattan. Then, on the tourism lever, I think that metros that rely largely on tourism are going to fare quite a bit worse than metros that don't. Sure, there are a few tourist-type places that have seen a surge in housing demand, like Lake Tahoe, but I would say that overall it's a safe bet that this type of hot demand will be limited to just a small handful of fairly exclusive remote destinations, and I'm pretty much willing to bet my life that affluent buyers from all over the USA are anything but eager to buy cookie-cutter tract development houses in places like Vegas. And then on the housing affordability lever, it seems that in a really short time span, the dynamics of where people live and why have shifted dramatically. No matter what happens, people do have to live somewhere. And with the recent surge in flexibility of the workplace, more and more employers are allowing and even encouraging their employees to be remote for quite some time. On this front, my projection is that people who are living in more expensive metros like San Francisco or Miami will begin to question why they're living where they're living, especially if they have jobs that are mobile. And as time passes, they're more likely to consider opting for less expensive metro areas where their housing dollars can go a lot further. We're already seeing rent declines in some of these pricey markets, which is a very telling indicator of a significant drop in demand. Cleveland is actually pretty well positioned on the winning side of each of these 3 levers. It's not hyper-dense by any stretch of the imagination, and most houses, even in the urban core, are large enough to feel very livable and also have a bit of yard space. On the tourism front, though they've been trying, bless their hearts, Cleveland just isn't a huge tourist destination, so not a whole lot of the local economy has been materially impacted by the abrupt stop to leisure travel. And then on the affordability front, Cleveland is a huge winner. Yes, there actually are towns in the USA that have housing that's more affordable than what you'll find in Cleveland, but these towns typically aren't going to be the centerpiece of a metro area that has things like Trader Joe's, pro sports teams, noteworthy cultural institutions, and Apple stores. When you add all this up, it seems very unlikely to me that Cleveland would see housing price declines in the next year or two, and actually much more likely that you would see continued price increases over that time period. If you have found this video helpful, please do help me out by smashing the like button down below, and share the video on social media or directly with someone you know who might find it helpful. Comment down below to let me know what other topics you think I should cover in future videos. And of course, subscribe to the channel so that you can be in the know every time I publish a new video. Once again, I'm Rob, and this is Cleveland Investor Primer. Thanks so much for watching.